Okay, so suppose you get a bonus because you do a great job and your boss gives you a bonus of $100,000. How much do you actually take home? So how much would be in your paycheck or your direct deposit? Less than 100,000, right? It might be something like, say, maybe it's 70,000. Why is there a difference? Right? Primarily because taxes are withheld, right? You have Social Security taxes, your Medicare taxes, federal income tax, state income tax, and you may also have like a pension withheld, insurance withheld, union dues withheld, and so forth. So basically, the difference is going to be what we call withholdings. Withholding. So who's paying all these taxes? You are, right? The employee. So the company's just taking the money from you and then they owe it to a third party. They owe it to the federal government, the state government, and so forth, right? So when you owe money to somebody, what is that? That's right, it's a liability, right? So withholdings are a liability, and specifically they're a current liability, right? Because they have to be paid right away unless you want to get in trouble, right? So I have here an example of some current liabilities. This is chapter 9, I believe, in your book. So one of them is going to be withholdings. We talked about over here, which we withhold from our paycheck. The most common current liability, of course, is accounts payable, which we've talked about many times before, which is money owed to vendors and suppliers. Another type of liability is accrued liabilities, member accruals. So something happens now and you pay the cash later. So for instance, you could have a loan and you can incur interest, but it's paid quarterly, so you have to accrue it until you pay it. So it would be accrued liability. Similar to withholdings is sales tax payable, right? So say you go buy something at Best Buy for $100, and what do they charge you? Like $108, right? The difference is sales tax. Again, who pays the sales tax? You do, the consumer, right? And Best Buy just takes your money and they owe it to the state. So it's a liability, it's sales tax payable. Another type of liability you should know is estimated liabilities. The most common is this, warranties. Right? So for instance, Best Buy may sell you a warranty for something, that's a revenue to them, but they're also required under GAAP to estimate what the future expenses may be under that warranty. So they have to estimate them and book a liability, and that's called, that would be an example of an estimated liability, so like a warranty payable. And the last type of liability we should know about is what we call contingent liability. Contingent means a loss that may happen in the future. And the most typical contingent liability is going to be a lawsuit. Right? If a lawsuit is filed against you and you feel that you may have to pay damages, you need to book that as a liability. And under GAAP, there's actually two criteria you need to know. One of them, it has to be probable, and the other is reasonably estimated. All right. So the two criteria to book a contingent liability is probable and reasonably estimated. So if somebody files a lawsuit and you meet with your counsel and they tell you it's probable that you're going to lose, and it could be like you could lose $1 million, you're going to have to book $1 million liability, and that's called a contingent liability. So these are common current liabilities. In the next video, we'll talk more about payroll. Thank you.